All right, welcome to today's Explainer. We are diving straight into one of Wall Street's most fiercely debated stocks right now, Salesforce. This is the company that literally defined the cloud computing era. They basically invented the software as a service business model that we all rely on today. But right now, it's sitting right at the center of a massive tug of war among investors. We're seeing some wild contradictions in how this tech giant is being valued. So today, we're going to break down both sides of this trade, look at the critical catalysts coming up, and detail exactly what you need to know before Salesforce reports its highly anticipated earnings on August 26th.
Here's our roadmap for today. First, the Salesforce valuation anomaly. Second, the bear case and market skepticism. Third, the bull case and the opportunity. Fourth, the critical earnings catalyst. And finally, number 5, Wall Street price targets.
Let's kick things off with Section 1, the Salesforce valuation anomaly.
Okay, we've got to start with this massive, glaring number. Right now, Salesforce is trading at a forward PE of just over 13. To put that into perspective, this is historically almost unbelievably cheap for this specific company. For a tech giant of this magnitude, the absolute pioneer of SaaS, seeing a forward price-to-earnings ratio sitting at 13.2 times, that is something that instantly makes financial analysts do a double-take.
And this perfectly illustrates just how weird this anomaly is. While the rest of the software sector is hanging out at a lofty 21 times earnings, Salesforce is sitting at a massive 40% discount, despite its historic dominance. Just think about that for a second. The broader software sector is being valued significantly higher, while Salesforce is heavily discounted. It's almost like the market is pricing them as some legacy industrial company in a totally different, slower industry, rather than a global software leader.
Since the stock has underperformed the market for 2 straight years now, this brings us to the ultimate question we're trying to solve today. Is Salesforce a value trap? Meaning, the discount is completely justified because the company's best, most innovative days are in the rearview mirror. Or is the market making a massive, historic mistake by mispricing a cash-generating behemoth? To figure that out, we have to honestly look at the arguments from both sides.
Moving on to Section 2. The bear case and the skepticism surrounding the stock.
Look, the market is pricing Salesforce this way for a reason, right? It's not totally irrational. The bearish argument really boils down to these 4 critical headaches. First, you've got slowing growth. Second, analysts are pointing out specific weak spots that are dragging down the broader portfolio, namely Tableau, Marketing Cloud, and Commerce Cloud. They're just not seeing that net new customer demand. Businesses are tightening their belts and not expanding their footprints. Third is a massive execution risk, specifically the recent departure of their president, Srini Tallapragada. He was basically the main architect behind their entire AI strategy. Losing your lead architect exactly when the AI arms race is peaking? Yeah, that gives institutional investors some major heartburn. And fourth, there's a very real fear out there that new, specialized AI tools might disrupt and automate traditional CRM workflows, which could make platforms like Salesforce feel a bit less relevant over time.
So the bottom line for the bears is that Wall Street is just completely exhausted by promises. They want to see actual top-line revenue re-acceleration, not just quiet earnings beats. Salesforce used to casually post massive 20% growth rates year over year. Now, they're guiding for roughly 10 to 11% revenue growth in constant currency for fiscal year 27. The market simply doesn't reward them anymore just for trimming the fat and beating expectations on the bottom line. The patience for this whole transition period is completely gone.
But let's look at the other side. Section 3, the bull case and the opportunity.
Let's flip the scales here because the bull case is undeniably compelling. The bulls are looking at the exact same data but drawing a totally different conclusion. First off, a PEG ratio below 1 means you are in deep value territory. Sitting at roughly 0.6, the stock looks incredibly undervalued relative to its earnings growth. But it's not just a balance sheet play, it's a huge tech play. While bears worry about AI disruption, bulls point out that Salesforce's AI platform, Agentforce, has already crossed over $1 billion in annual recurring revenue. Some estimates even put it well over $2 billion. That means Agentforce is pulling in real, meaningful cash right now. It is definitely not vaporware. Plus, releasing tech like Headless 360 and Data 360 MCP Server is an absolute game changer. It allows AI agents from any source to interact directly with Salesforce's massive troves of proprietary data.
And underneath all the narrative noise, the core business is literally a cash machine. Just look at those gross margins sitting at an incredible 77.6%, alongside super disciplined operating margins at 22%. This right here is the rock-solid foundation of the bull case. We aren't talking about a struggling, cash-burning startup trying to find its footing. We're talking about a highly profitable giant trading at a discount largely because of narrative fears rather than any sort of fundamental business failure.
When you pair those fat margins with an exceptional free cash flow yield of 9.4%, you get a profitable behemoth with massive room to invest and buy back stock. For a large-cap software company, a 9.4% free cash flow yield is, well, it's just off the charts. They are generating enormous piles of cash, and more importantly, they are returning that cash directly to shareholders. For an investor, a yield this high acts as an incredible shock absorber against any market volatility.
Which brings us to Section 4, the critical earnings catalyst.
This is where things get real and highly actionable for you as an investor looking at the immediate future. Because all these debates between the bulls and the bears, they're going to collide head-on. But before we get to the actual upcoming date, we have to demystify one absolutely crucial metric, cRPO, or Current Remaining Performance Obligation. You're going to hear this term a lot in software earnings. Simply put, it is the single best leading indicator of future subscription revenue. Why? Because it tracks contracted revenue that hasn't been officially recognized yet. If this number decelerates, the bears are right, the slowdown is real. But if cRPO accelerates, it means customers are signing bigger, longer deals, and the bulls take the win.
So mark your calendars for August 26th, because this is your exact checklist for the earnings report. This is how you'll know if management can actually deliver on those promises of re-acceleration. Step 1, like we just said, watch that cRPO growth like a hawk. Step 2, check the revenue guidance for the second half of the year. Management promised re-acceleration? Well, the market demands hard numbers. And step 3, verify Agentforce's contribution. Investors desperately need to see if Agentforce is actually driving net new top-line revenue, or if it's just cannibalizing existing revenue streams and, shuffling deck chairs on the Titanic.
Finally, Section 5, Wall Street Price Targets. Let's see how all of this data builds into the ultimate risk and reward scenarios on Wall Street. Despite the recent sell-off, the consensus among major banks remains surprisingly bullish, signaling that the stock is pretty undervalued right now. Oppenheimer, Cantor, Fitzgerald, and Guggenheim all maintain $250 price targets, with Outperform, Overweight, and Buy ratings respectively. JPMorgan and KeyBanc? They're also holding confident Overweight ratings. So the institutional consensus is clearly leaning toward the bull case, heavily suggesting that if Salesforce can prove its AI thesis, there is a whole lot of upside left on the table.
If Salesforce actually proves its AI thesis on August 26th, we could see a massive re-rating higher. In the bull scenario, if Agentforce drives net new revenue, cRPO accelerates, and guidance goes up, the stock could re-rate all the way up to 18 or 20 times forward earnings. That could shoot the stock price up into the $280 to $300 range. But if they fail to execute, it's going to drift lower. Thankfully, though, even in the bear scenario where guidance is weak and Agentforce totally flops on delivering incremental value, the downside risk is actually highly capped. Why? Because that incredible 9.4% free cash flow yield and their aggressive share buyback program act as a virtually unbreakable safety net for the stock price.
With the August 26th catalyst rapidly approaching, you've got to look at these conflicting signals and decide which side of the scale you are weighting heavier. Salesforce right now is a high-conviction, high-risk opportunity. The valuation is undeniably attractive, absolutely. But the entire investment thesis hinges on management's ability to seamlessly navigate this super tricky growth transition and actually monetize their massive bet on AI. So I'll leave you with this to ponder. In a market that is constantly driven by wild narratives, when a defining giant of the cloud era is trading at a 40% discount, are you brave enough to trust the cash flow? Or is the fear of AI disruption just too great to ignore?